This is Mark Sobel, U.S. Chair, OMFIF. Today, I have the great pleasure of welcoming Governor Christopher Waller, who joined the Federal Reserve Board late last year after serving as Executive Vice President and Director of Research at the Federal Reserve Bank of St. Louis for over a decade. This event is being live streamed. Dr. Waller and I will hold a discussion for perhaps the first half of this event to set the table for audience questions, which can be submitted via the Q&A function. Governor Waller, welcome to OMFIF, and thank you for joining us today.
Well, thanks for inviting me to join today, Mark. I appreciate it and looking forward to the conversation.
Good. Well, let's see if you feel that way after you hear the questions. So, everybody tuning in wants to hear your view on the macro outlook, labor markets, prices, implications for monetary policy, for tapering, for liftoff, et cetera, et cetera. So let me just give you the floor on this inevitable question and let you answer before we dig deeper.
Yeah, so this, the pandemic has been a kind of an interesting and unusual shock to the economy. And the way it hit, I always had a view that the economy on the real side would recover relatively quickly. And it has in the US, I'm speaking for the US. So for example, GDP is back above its trend growth path from pre-pandemic. So we've recovered all of GDP to date in just about 16 to 18 months. The unemployment rate skyrocketed to 14.8%, and it's now down to 4.8. So the unemployment rate has fallen 10 percentage points in, again, about 16 months. This is just shocking to see that big of a movement in the unemployment. Everybody was kind of forecasting it to stay high and just after like the last recovery, come down very slowly. So the real side has really come up. Unemployment's come down. We still have a large number of workers out of the labor force for a variety of reasons. But the Fed has done as best we can to create the demand and the jobs. And now we've got plenty of jobs, and now it's just getting the workers to match up with the jobs. And that I expect to happen over the next few months. Once COVID kind of wanes and that kind of fear, childcare becomes available, schools stay in session, things like that, then I think there'll be a movement together back in the labor force, and a lot of these jobs will be taken. Now that's on the real side of the economy. On the inflation side, I and most people did not expect the inflation that we have seen for the last bit. Now we knew there was a demand stimulus that was going to have some effect. We knew there's going to be some rebounding in service prices and probably some retracing of goods prices. But I don't think any of us foresaw the extreme bottleneck supply chain problems that we saw. I mean, I'll be naive. My own view was, you kind of shut the economy down and then you just kind of started back up and everything works fine. But I think the thing I didn't really take into account was that COVID and the Delta variants were going to impact economies at different times. So as one economy was taking off, one was going back into lockdown measures. And this kind of non-synchronized reopening led to these kind of constant intermittent problems in supply chain that just make it drag out much longer than I certainly thought it would back in April. So inflation has been high. My base case is that inflation will pull back in 2022 back towards our target, not necessarily getting back to 2%, but pulling back closer towards it. But I mean, there's much more upside risk than I anticipated that this may continue on. So as I mentioned in the speech the other day, the next few months for me are critical in seeing whether inflation actually is going to be transitory, or is it running the risk of becoming ingrained in expectations, wage demands, price structures by firms, and whatnot. And if that were the case, we would have to be much more aggressive in our policy stance in 2022 than I was expecting.
Well, thank you for that. I read your speech. It was very interesting in its analysis of labor markets. And I think, as you just kind of alluded, I find the inflation picture confusing. One could see it as largely reflecting a series of relative price changes that have accumulated, or some are suggesting it, no, it could be a more generalized phenomena. And also, it's kind of hard to discern how long higher prices will endure and whether they may settle back a good bit over 2%. We we've seen some relative prices coming down. Car prices, I've seen some measures coming down, but on the other hand, there's talk about sticky prices having an impact from housing. We've seen energy prices up. I was wondering if you could elaborate a bit on your thinking on inflation prospects. And something I find interesting, I think Olivier Blanchard proposed 4% inflation target for Germany, and a lot of people have debated, what's the sacrosanct about 2%, although it's there. I mean, if prices settle back around 3% in the United States, would that really be a problem for the US economy?
Yeah, so this is always kind of an interesting debate about what the optimal inflation target rate should be. The view has always been we want it to be low and stable, and we kind of settled on through the Greenspan era, kind of 2% as the appropriate definition of price stability. But because of the zero lower bound problem, which kind of we never really thought we would face back when this 2% number was becoming the norm around the world in central banking, we just thought keep inflation low and we'll be fine. So real rate or natural rate of interest 2%, inflation, Fed funds rate should be around 4. That works. If you got to tighten, you can go above 4. If you have to come down, you've got a lot of range to move down. Well, what we've seen is the neutral rate, the real neutral rate, has just steadily fallen on safe government liquid assets for the last 40 years to where it's now potentially near zero. And that suddenly then brings your neutral policy rate down a lot lower than it was in the past. So this is where the arguments for, well, then just raise the inflation target so that you have more room on the nominal side to bring interest rates down. So the issue I always tried to frame that debate as, for an 4% inflation target, I think of inflation as a tax on economic activity. We always call it an inflation tax. So you're asking the following question: do I want to have a permanently higher tax distortion on spending in order to, on occasion, be able to lower the interest rate down when recessions hit? So it's like an insurance policy. You're either going to pay this premium so that in bad states of the world you can take a certain action, or you don't. You just say forget it. So I really think of it as that's really the trade-off. And in that sense, it's more of a quantitative issue of how big this tax is and how big are the benefits in these periods when you have to lower rates. So I don't have a clear answer to what that is, because you'd have to tell me like what are those benefits and costs. For now, I tend to stick with the low inflation and just go with that.
Well, thank you for that. And I took away from your opening remarks that while you see inflation coming down, it's a bit of a question mark. There are a lot of uncertainties about the actual price outlook, and the next few months will be interesting. Well, your remarks bring me to a question about flexible average inflation targeting. So the FOMC has said liftoff won't happen till labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. So, I recently interviewed Bill Dudley, and he expressed concern that these conditions might put the Fed behind the curve. And I was wondering what you would say to Bill. And while I'm at it, is there anything you would like to tell us about, anything more you would like to tell us about the Waller dot?
So one of the things, I guess, what we have learned in the past, when the FOMC would set policy, we had a very Phillips curve view of the world. And monetary policy would hit the economy with long and variable lags, as Milton Friedman said. So because of that, we could project inflation was coming. And if we wanted to head that inflation off, we had to move now in order to stop it down the road. So that was what we did. The concern is that we were getting too far ahead of the curve. I mean, you can go in the ditch by being too late or too early. You don't have to always be early, and that's a good outcome. And that was kind of the view, is that we may have choked off recoveries by raising rates too preemptively. That's the argument. So that it might be better, and given how flat the Phillips curve, and it gave us no predictions of inflation in the last 5 years. I mean, we had unemployment going down, 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 down. Models were telling us inflation's going to go blasting through the roof, and it just didn't. It just stayed below 2%. So because of that, there was a change in thinking that maybe we don't have to be so preemptive to fight inflation, that we can actually wait longer, actually see the inflation starting to build rather than anticipate it and then chase inflation ghosts that don't ever materialize. And then we can react. If we have to, we can react quickly to try to chop off the inflation. So that's the view for waiting longer, waiting to actually see the inflation as opposed to anticipating it and then potentially vanquishing inflation ghosts that never arose. So that's where we were. So the idea was we hadn't seen any inflation for 10 years, basically. So we could wait. You know, nobody saw any, we weren't experiencing inflation. Nobody was forecasting inflation. The concern was we were never going to get to 2% inflation. So we adopt this new framework and wham, we got inflation. So when we adopted the framework, our view was we'll tolerate a moderate overshoot of inflation for a while instead of trying to choke it off in advance, so we can let the labor market run a little bit hot. We never anticipated inflation running 4 to 5%. That was never on anybody's radar screen as a possible outcome, and nobody thought that that was a moderate overshoot. So that's where we've kind of got ourselves in this position that we wanted inflation to go up. We wanted to have kind of an average 2% instead of thinking of 2% as a potential ceiling on inflation. And now we're in this position. So we're in this tricky spot of now we're staring at, if inflation continues to run this hot and this high, we can't necessarily focus on just the labor market, particularly if inflation expectations start coming up. We've got to get those things back under control. So this was what I said at the beginning of our conversation, that because inflation's running hot for so long, we may have to step in earlier to do something than we originally thought we would have, say, a year ago before we saw this. As for my dot, I like to keep my dot private. But I'll just say I've always had a very optimistic outlook for the economy. The recovery would be much faster than many people thought. So I'll just leave it at that.
Great, great. So low interest rates foster an environment in which there's reach for yield and stretch valuation. U.S. banks are sound, but there are plenty of financial stability risks in markets, often emanating from the non-bank sector. And obviously those risks can hit the dual mandate. Do you see financial stability risks as elevated? How can the U.S. better keep elevated financial stability risks from potentially impacting the conduct of U.S. monetary policy? This is the separation issue, which you're familiar. And do you have any concerns about financial stability risks in areas outside the Fed's remit, and thoughts about, if that's the case, what should the Fed do about those?
Yeah, so most of the examples of financial instability or crises we've seen usually were preceded by some big credit bubble of some sort. Certainly the housing market crash that we saw in 2000, 2008 was all credit fueled, certainly by household debt. We don't see that now. We don't see anything that looks like a credit fueled bubble. And so then the question is, if that's not the problem, if household balance sheets are in good shape, firm balance sheets appear to be in relatively good shape. Firms are sitting on a ton of cash on their balance sheets. Then where is the potential thing that could spill over into the banking system? And we're just really not seeing anything. We have a financial stability group at the board who keep an eye on this all the time, report to us regularly. We're just not seeing it. Even with the high housing prices that we've seen run up, this is a lot of fundamentals. This isn't necessarily a bubble. The fundamentals are kind of simple. We had this COVID shock. People have decided to work from home. Businesses are allowing people to do remote work. So people don't want to be sitting in the kitchen opposite their husband or wife, trying to both have Zoom calls at the same table. So they want space, they want a house, they want to get away. They can afford to live farther from the city because they don't have to come in as often. So that led to a shift in total demand for housing. The other thing, at least for the US, millennials were on the sidelines for the last decade in terms of buying homes. Partly they watched their parents lose their homes, the housing markets crashed, people lose their wealth. They had student loan debt. They weren't in a position to buy houses. But combined with COVID, they have now come in off the sideline and started buying homes. That's going to last. That's not going away. They're not going to just wake up tomorrow and say, no, never mind, I'm going to go back and live in my parents' house with them. So those are kind of fundamental demands, plus low interest rates obviously make financing affordable. And we know interest rates for any asset tend to cause upward pressure on its price. So there's a good fundamental demand. What we're not seeing is credit driving these home purchases and households getting over leveraged. So despite the rapid rise in housing prices, it doesn't look like it's a credit boom or it's going to create problems for the banking system. In the non-bank system, again, we look at a lot of different things. There doesn't seem to be anything that's dramatically out of order. But if they do, it would show up and we would be there looking at it much more closely than we might have 15 years ago.
Thank you. Let's shift gears a bit. You recently gave a provocative speech, and I quite liked it and compliment you for it. It was entitled "Central Bank Digital Currencies: A Solution in Search of a Problem?" ? And you pronounced yourself a skeptic. I think that's a quote. We're obviously all waiting for the Fed discussion paper on the costs and benefits of creating a digital currency. I've noticed that I never touch cash anymore. I use my credit card linked to my bank account. I frankly don't really lose any sleep over the fact that I'm using private money as opposed to public money, since my bank account is overseen by U.S. supervision and deposit insurance. I appreciate that we need a faster, less expensive payment system. I guess you could support CBDCs if they render stablecoins superfluous. I think I heard the chair allude to that. I guess one could also support stablecoins as they reflect innovation, but one would want them to be properly regulated, perhaps as soundly as bank deposits. Just how do you see central bank digital currencies, and would there be demand for stablecoins in the U.S. if they were as soundly regulated as bank deposits?
Yes. So the question with stablecoins is kind of a basic one. When the Fed was founded, we were given responsibility for the stability and efficiency of the payment system. A critical question you have to ask is, what is the Fed's operational role in the payment system? Now, for the last century, we have taken a very simple approach. We let the private sector banking system conduct retail payments for households and firms, and our main job is to be in the background and make sure that the payments are transferred smoothly across banks. Now, there are times we've stepped in and taken some direct blow, like developing ACH payments in the 70s. But for the most part, we let the private commercial banking system do that. With the CBDC, you're asking a very direct question. Should the central bank be more involved in the processing payments for households and firms in a way that allows them to circumvent the banking system? That's the fundamental question of what a CBDC is, because that's what a CBDC account is doing. The confusion is people somehow think it's like Bitcoin. We're going to create this digital, semi-anonymous. token that can be used peer. That is not what we're talking about at all. We're not creating anything like that, nor are any other central banks creating anything like that. So that's really the fundamental question. Should the Fed step in and be more directly engaged in processing payments for households and firms and circumvent the banking system? So should you compete with the banking system or not? In the US, the general view is that the government does not directly compete with the private sector in everything. You know, as noble as wanting everybody to have an electric cars are expensive. I don't hear anyone saying the government should start building electric car plants and compete directly with Tesla or any of the other electric vehicles. So that's really the question you have to ask. What major market failure or problem is out there that requires the Fed to step in and do this and become a direct competitor with the private payment system? And that's what we're looking at. You know, there may be reasons, there may be benefits. There are obviously going to be some costs to doing that because we don't typically do it in other products or services in the US economy. So that's what I really want people to focus on is that's what you're going to be doing with this. Should you do it and why? If we end up making a decision to do it, that's fine. I really honestly think this is a question for Congress. I don't think it really should be the purview of unelected Fed officials, to a group of 6 or 7 of us, to sit down and say, yeah, we're going to do this major change in the way the Fed interacts in the private sector. I'd much rather have Congress say, do it or don't do it, than for me to sit down and make that decision unilaterally.
Great. Let me ask you a question about central bank independence, fiscal dominance, and the like. Obviously, fiscal and monetary policies work hand in hand. The Fed is said to be independent. I personally think that's a bit of a misnomer, as the Fed operates in an accountability framework. The mandate is set by Congress. The Senate approves board members such as yourself. But the Fed does have the ability to use its instruments as it sees fit. Now, in many countries around the world, and even in the US prior to the Treasury-Fed Accord, or in the 1970s, there were pressure on the Fed to keep interest rates low and support government financing. Today, on top of that, with discussions about climate finance and inequality, some believe, fairly or not, that the Fed is being pushed in the direction of mission creep. So do you have any thoughts on fiscal dominance, and are fiscal dominance and mission creep something on your radar screen as a possible concern that you'd have, that it might ultimately compromise the Fed's instrument independence?
So yeah, when I think about independence, you're right. I always think about 2 things. There's independence and accountability. You can't have one, you can't have independence without the other. That's just not going to work in a democracy. Everybody's accountable to the electorate. What Congress did was they gave us our goals. We do not have goal independence. They gave us our goals through our dual mandate, but they've given us independence in how we pursue those goals and try to achieve those goals. And the instruments that we use narrowly that we can use, typically the interest rates and asset purchases, to try to achieve those goals. So in our mandate, it is our responsibility to achieve maximum employment, price stability, and financial stability. It is not in our mandate to provide cheap financing for the US government. Now, Congress could change that and put that in there, and then that would be what we'd have to do. But it is not in the mandate we have now. So just talk that we have to do this as some side deal, I think is wrong. And that's what I was trying to stress in my speech earlier this year. We're going to do policy to achieve the mandate that Congress gave us. Now, we do have to work with Treasury every day because we're the fiscal agent for the US Treasury. And that has to be done efficiently at minimum cost. So we have to work with Treasury. We take orders because we're their bank when it comes to paying for things. So they're the client. So we have to do it. We give them advice and as best we can in terms of how things could be done, how more efficiently they could be done. and we carry out that work. That has to be done and done well every day, and that requires close cooperation between the Fed and the Treasury. And then finally, there are these crisis periods, such as the Second World War or a global pandemic, where we have to work closer. And that usually comes through 13.3 facilities. Congress gives us the authority to work with Treasury to set up facilities to try to help the economy. And that's what we did. And that was the right thing to do. And then when it's done, the facilities go away as they did. So what I don't want is things creeping into our mandate that aren't there given to us by Congress, that suddenly the Fed is expected to fix, because then all kinds of things come in that potentially one side may like, another side may not like. So my view is, look, if there's something you want us to do, Congress should tell us to do it.
Well, thank you. Well, maybe we can start transitioning to audience questions. One thing you said earlier was you were optimistic about U.S. growth, and you also said that you saw inflation in your base case assumption, of the uncertainties around that. You saw it transitioning down. There's a stagflation debate one hears. Summers and Rubini have talked about it. It sounds as if you're not a proponent of that view, but perhaps you might wish to amplify.
Yeah, so when I was a college professor, if I was teaching about stagflation, I would say, what is stagflation? High inflation, high unemployment. That would be it. And you have high unemployment because you have really bad economic performance. We're not in that situation. We may have inflation that's running higher than we wanted, 4 or 5%, but unemployment is falling. It's at 4.8 and continuing to go down. The labor market's recovering. Jobs are plentiful. The problem is not a shortage of jobs, which is normally what happens in a stagflation environment. We have like 10 million jobs open looking for workers. So that's the point, that between the Fed's policies, fiscal stimulus, the demand for labor has been created. The problem is the labor's not coming off the sidelines at the moment to take those jobs for a variety of reasons. All right. But it's very hard for us to try to force people off the sidelines. We can create conditions to give demand, to create the jobs, but getting people to come back into the labor force and take those jobs, that's the harder problem. So I don't see it. Plus we have growth. We have a slowdown of growth this quarter, but we all are seeing growth into 2022, 4 to 5%. The bottlenecks that we're observing in supply chains, those aren't stifling demand. They're just shifting it to the first half of next year. That's my view anyway. People are just going to have to wait to get their bicycle parts or to get their TV or get some microwave. Yeah, but they're still going to buy it. It's not like they're not going to buy it because they have to wait a couple of months. So I don't see anything in the growth slowdown right now creating growth slowdown in the future. So I just don't think that this word is the right word to be using for the current situation.
There are a bunch of questions coming in on monetary policy. Is flexible average inflation targeting symmetric? Do you have the tools to deal with 4 to 5% ramp up in inflation?
Yeah, so on the flexible average inflation targeting, this is kind of a new experiment, clearly, in monetary policy. It hadn't really been done before. But the concern was that our 2% inflation target, which we all viewed as a symmetric target, I used to put it this way, I'm as unequally happy with 2.5% inflation as 1.5% inflation. I'm missing my target. I don't care. I'm missing it this way. But the general perception was the markets in particular were coming to view 2% as a ceiling. And that, as we saw in the last few years prior to the pandemic, inflation market expectations were starting to drift down below 2%, closer to 1.7, 1.8. And then we had a problem. And the issue was, how do we try to get inflation expectations to come back up to 2? And the idea was you had to somehow commit to let inflation go above 2%. It wasn't a ceiling. And this was one way to do that. So you would be willing to let inflation run high for a while or moderately above target after a period of running below target for a long time, which we did for almost a decade. So that was the idea, that on average, we are going to make sure we hit 2% and that this is not going to be a ceiling. So that's really the way we're looking at it. And we'll see how well. Certainly inflation expectations have come back up. That was achieved. That was clear. It didn't take long for market inflation expectations to come back to 2 and actually go above 2, but they're anchored in the long run, right? They haven't gone up in the longer horizon. So I take this to be a success of the framework so far, that markets are letting us run inflation above. It's maybe too high right now, and I don't want to see it stay there. But they're giving us the flexibility to run it above target for a while, with the belief that we'll bring it back down to 2% in the future.
There's some questions around uncertainty. So when there's greater uncertainty about the inflation path, how do you account for that in your decision making? And one person asked if this might nudge the board to articulate some further concrete parameters around the flexible average inflation targeting, such as how far past 2% before one tightens, for example.
Yeah, I mean, everybody, all business decisions, all life decisions are fraught with uncertainty. We all, it's just a part of every human being's life, is having to deal with it. For us, the key thing is we actually have to take actions that affect all of society. If I have uncertainty in my personal life, I bear those costs, or benefits. But for us, the rest of society has to bear the benefits and costs of those decisions. So with uncertainty, we weigh risk to the upside and the downside. And there is a sense in which, with uncertainty, there's a principle of kind of moving slower and not in huge steps, which is often what you see with FOMC policy. We kind of go at a measured pace. That was a famous phrase. And we don't typically do 50 to 100 basis point moves at any point in time. So this is where the uncertainty and the concern that you may be wrong, so you don't want to do big movements and you don't want to go really fast unless it's really warranted. That's how it comes into play. On inflation, clearly for a decade, the risk was to the downside. We weren't going to get inflation to 2%. Well, the last roughly 6 months have shown us, wow, there is this upside risk that everybody had pretty much discounted 6 months ago, but it's there. And now our biggest upside risk is it's going to continue longer than we thought. I mean, we all, myself included, all thought by the end of this year, there are going to be some retracing, inflation is going to cool back down, supply chains are going to unravel, all these knots and problems will unravel, and we'll be back on track. Well, that doesn't seem to be quite working. And if anything, it seems to be piling on to each other. So it's going to take a while. And what I don't want, none of my colleagues want this to get embedded in inflation expectations, wage demands, pricing of assets. That's what we don't want. We have to make sure that that doesn't happen.
I wanted to come back on this question of that we touched on during the financial stability question about separation of financial stability from monetary policy. The academics say, well, if you're going to have separation, you need good macroprudential policy. On top of good microprudential regulatory policy. I was wondering if you had thoughts on the state of U.S. macroprudential policy and whether you felt it was adequate to deal with the risks, be it in banks or non-banks.
Yeah, so I think the view has long been that I certainly know, I think Chairman Bernanke saying this often was, we use monetary policy and interest rates and asset purchases for the real economy and inflation. Financial stability issues are best done with macroprudential, and we have the tools to do that. So one thing that's been clear, regulatory policy has had an impact. The Dodd-Frank bill led to raising of capital standards for certainly all banks, the largest banks. They went from something like capital ratios of 4 to 5% to now over 12. So, regulatory actions on that side, that would be a macro stability tool, raise capital standards. And we did, and it paid off. It paid off during this pandemic. The banks got through this quite well. And the capital standards that we put in place were a big factor in that happening. Now, in terms of doing macro stability where you're actually fine tuning it to the business cycle, that's a little trickier. I know it's one of these things that sounds great in practice to an academic and a theoretical model. I do it too. I'm not casting stones. But doing it in practice where businesses are actually having to adjust on the fly to doing changes in your rules, this is not as easy as people think it is. That we never take those kind of adjustment costs on the private sector into account. So it's a little trickier to be kind of moving the levers on firms and banks and financial firms up and down based on monthly or quarterly data. So these are going to be much more slow moving tools. They're not going to be really cyclical based. There is talk about countercyclical capital buffers, which right now we don't use in the US, partly because we think capital's high enough that you don't need this extra buffer. But that can change. I mean, there may be a decision that we want to more actively use countercyclical capital buffers. So I would say that the critical thing for us for financial stability, at least in the non-shadow part of the financial system, is we've kind of got capital standards, regulations, supervisory rules all in place that have kind of taken out a lot of the financial stability risk that was in the system 10, 15 years ago.
A question coming back to the transitory versus persistent debate, if one wants to use those words. Could you elaborate on whether you see it as a series of relative price changes or supply side factors versus a more generalized phenomena? And if it's more the supply side issue, how does that affect monetary policy? Can raising rates be effective in that environment?
Yeah, so the thing is that when we talk about trend inflation as economists and academics, we think every good in the economy is raising its price at 2% a year smoothly, and there's no question, no argument that inflation is 2%. But in the real world, that's not how prices adjust. Some prices are sticky for a long time and then they jump. Other ones might be moving slowly. But the thing is because they're not all moving in like the same rate, in the same direction, we tend to look at the data. And as I was talking in my speech the other day, there's a tendency to want to manipulate the data, the way you look at it, to kind of throw outliers out. Oh, that's a large price increase. All the inflation was driven by that one good, throw it out. And then next year, there's some other good that's driving everything. And we say, oh, throw that one out. And everything looks fine. So it's kind of a fallacy you have to be careful of, because every year there are going to be some goods with big price increases, but you can't ignore them because over time they all will be moving up because of these big price increases. So what looks like a relative price increase, because one good jumps much more than the other, you'd say, oh, it's a relative price, it's a supply shock, whatever, we can ignore that. No, because next year there'll be another one and another one the year after that. So you have to be very careful because of the way prices adjust and prices are set to start dismissing, this good for that's the reason for it, so we can ignore it, or next year we'll ignore this one. So that's my concern with trying to tease out what is the true underlying rate of inflation, we start cherry picking too much and throwing out too much information that we should kind of keep an eye on. So I understand why we do it. I do it myself. I'm not casting stones at anybody, but you always have to keep in mind that you want to be careful when you start throwing things out that you're throwing away valuable information.
There's been some recent research out of the Fed on inflation expectations. How do you think about inflation expectations as a concept, and how does that relate to your monetary policy judgments?
Yeah, I mean, since the 70s, inflation expectations have been a critical factor in every macroeconomic model I've ever seen for good reasons. And we learned in part that it was critical for a central bank to have credibility by keeping inflation expectations anchored. If you lose those expectations, your credibility is gone. It's done. And once that happens, you've got a lot of problems that you got to suddenly deal with. That's a large part of the story from the 1970s. Inflation expectations kind of became unanchored. The Fed's credibility in fighting inflation was going out the window. And it took the Volcker disinflation and very clear Fed policy and communication since then that we are going to keep inflation low and stable to build up the credibility in both markets and households that we are not going to let inflation get out of control. Now, if you keep inflation in a 1% to 2% band and it hardly moves around, or it's just kind of bouncing around for idiosyncratic reasons, and inflation expectations are 2%, you're not going to see much correlation between the two. Inflation is kind of bouncing around, inflation expectations are constant. You wouldn't expect inflation expectations to be able to predict what next period's inflation rate would be. Where they're going to predict is when you're in this situation when things get out of control. Then inflation expectations are going to be a good predictor of inflation. We don't want to get to that point, right? So that's the critical thing. We don't want to get to the world where inflation expectations become a really good predictor of what inflation is, because they're starting to build those inflation expectations into pricing, wage demands, everything else. As long as people are kind of inflation's 1% to 2%, people can have kind of rational inattention and just kind of ignore what actual inflation is doing. So that's, I think, the problem. We had a period in the 70s with high inflation and poor data on inflation expectations. And now that we have good data on inflation expectations, inflation has been relatively stable. So we haven't really been able to get a good test of how much inflation expectations predict actual inflation.
How do you see the role of a central bank in combating climate change?
Well, climate change, I kind of take the view climate change is like anything else. It's an exogenous factor that has impacts on the economy, and we have to take how that might potentially impact the economy. So from that point of view, it's just like any other factor. We take fiscal policy as an exogenous factor to us in setting policy. We take the ECB's monetary policy as an exogenous factor to us. And then we make our decisions based on what other things are happening. The bigger issue is whether the Fed should actively take actions to enact policies that go one direction towards climate change or not. Should the Fed restrict lending to green industries and discourage lending in brown industries? To me, that's Congress's job. If Congress wants industries not to receive credit, that's their job to tell them, not mine. I'll simply take into account how climate has impacts on potential financial stability, how it might affect supervision of individual banks as an external factor. But I don't want to be forced into a role of taking policy positions as to who gets credit and who doesn't based on climate. If Congress wants me to do that, then tell me to do it. But I'm not going to do it without Congress's approval.
How do you so in 2013 we had the famous taper tantrum, where pronouncements from the Fed had ripple effects, particularly sharp for emerging markets. Obviously what the Fed does is going to affect the global financial markets. But are you focused on possible other taper tantrum? How do you think the Fed tapering and prospective rate actions may impact the emerging market space?
Well, in 2013, we were starting to talk about taper. My memory's not exactly clear, but I think the first mention of tapering was in May, maybe early 2013. And then just literally a month later, Chairman Bernanke goes out in his press conference and starts saying, hey, we're thinking about tapering later this year. We weren't tapering, but we were thinking about it. And it sounds shocking to me, but like it's a month to 6 weeks was not enough time to prepare the financial markets. People that incorporate information in seconds apparently need months of warning from the Fed when it comes to things. But it was clear that you can't just like drop this and expect everything will be fine. That it'll all be taken into account and everything will work well. So I think that was one general concern, is we didn't prepare the markets enough in advance to, hey, get ready for this possibility. That has been done this time. Chair Powell's done a wonderful job of signaling. The FOMC has done a good job of signaling, look, get ready. We'll give you a long advance, but get ready to start taking this into account. And I think the markets have taken it all into account. As far as I know, a late 2021 taper has already been priced in by almost everybody. So how it could cause a shock when it's already priced in is a bit puzzling to me. The second thing in 2013 is we were talking about pulling that back on accommodation, but our economic outlook that we were putting out in the SEP in June of that year actually was kind of negative. Growth was kind of not going to do well. Unemployment wasn't coming down, and you're talking about tapering. So we had these conflicting signals about tapering and tightening policy when you didn't have a very good outlook. That's not the outlook we all have now. The outlook's all relatively good in terms of falling unemployment, GDP growth still being high, inflation coming back to trend. So tapering fits with that outlook. And I think that's a big difference, again, between now and 2013, is give the markets advance. The tapering decision is consistent with the economic forecast. So there shouldn't be any big shock when it actually happens.
Yeah, this prompts me to ask a question. I've been a Fed watcher at the Treasury for a long time on the international side. I remember in the 90s, Greenspan would say that the Fed takes foreign developments into account to the extent that they impact the optimal functioning of the U.S. economy. It was a very real economy focused point. Financial markets have grown. Financial transmission effects seem much stronger in this world. I was wondering how you as a policymaker think about the foreign sector in its impact on your monetary policy decision-making.
Yeah, I'm probably still in the Greenspan kind of view, which, like I said earlier, I take the foreign sectors as a given. I take that impact, what other foreign central banks do, what other foreign governments do for fiscal policy. I just take that as part of the state of the world I have to deal with. I don't kind of adjust just in response to their policy. I'm not going to say somebody did something to weaken their currency against the dollar, so we should do something. That's not any way that I would ever think about doing policy. So we take these actions as given from the foreign sector, and then we make our optimal policy decisions. Those policy decisions are going to affect those foreign economies as well. That's part of their job to deal with that. I always, again, try to stress, Congress has given me responsibility to try to make sure that the U.S. economy achieves its goals. The U.S. Congress is not giving me the objective to make Europe better, China better, Latin America better. My job is to try to make sure the U.S. economy performs well. If the U.S. economy performs well, everybody else will perform well. That's just always been kind of the case for the last many decades. When the US doesn't do well, nobody else is typically going to do well. So our good, healthy US economy is good for everybody else.
Great. Coming back to the digital currency space, China seems to be somewhat forging ahead in creating a digital RMB. You know, a lot of analysts say, oh, this is going to have big implications for the global financial system, for the dollar's preeminent financing and reserve role. I'm a skeptic on that point, but how do you see it?
Yeah, this is an argument I find very puzzling, actually, because if you think back to what I said, what I read the Chinese Central PBOC's white paper, so I read it carefully. They're doing what I just said. They're going to allow people to have payment accounts with the Central Bank of China. So now if you want to pay your electric bill in China, you can run the payment through the Central Bank of China instead of going through a private bank. If you're a firm and you want to have like an account, of course, the problem is they're going to have maximum limits. So no firm is actually going to be able to run anything through there. I'm just puzzled as to why, first of all, anybody would want the PBOC to observe all their financial transactions, which they said they would above some minimal transaction size. Why any US firms would invoice, trade, use the Chinese yuan, because they can now have a checking account with the Chinese central bank. And this is a mystery to me, why people think this. Somehow in their head, people think China's creating a Bitcoin kind of peer-to-peer token that can be traded without going through. That's not what they're doing. That is not what they're doing. They're just saying, if you want to run your payments through us, you can do it. Now, why that would be a threat to the dollar as a reserve currency in the world, I have no idea. I just cannot fathom how this is a security threat or to the status of the dollar as a reserve currency. The dollar is a reserve currency because of well-functioning laws in the US, credible monetary policy, non-political interference in monetary policy, and a good, stable financial system. That's why it's a reserve currency, not because you can run your payment through the Federal Reserve instead of your bank. So I just find this one of the most amazing arguments without anybody actually thinking what this thing is that you're able to do and why that ability to pay your electric bill is going to supplant the dollar as a reserve currency.
Well, great. That was a very clear answer.
Maybe too clear. I need to work on more ambiguity.
I think I've kind of given a somewhat similar, unclear answer. Well, let me try a provocative question. Have you begun to think about balance sheet policy after tapering? And if so, would you like to share some of your thinking with us?
Yeah, I mean, it's fascinating that prior to the financial crisis, you know, the size of a Fed's balance sheet was never even discussed. It wasn't in any academic lecture. I never lectured on the size of the balance sheet. Nobody cared. It wasn't until the Fed began and other central banks began to do large scale asset purchases that suddenly people are like, wow, there's this other tool they can use, which is to, you know, blow up the balance sheet to buy various assets or longer dated assets than just dealing in short-term money markets or financial markets. So, you know, we undertook very dramatic policies, QE policies from 2009 through 2013. It pushed up the size of our balance sheet in the US from $800 billion to $4.2 trillion. And going to 4.2 trillion just freaked people out. It's like, oh my God, what's going on? This is going to cause massive inflation. They're printing money. They're doing all of this. All this worry about the size of our balance sheet, it hasn't done anything. There's no theory that I'm aware of, and if anybody has one, let me have it, of how large a central bank's balance sheet should be. So we were at 4.2, we got it down to about 3.5 trillion, and now it's closer to 9. I don't hear anybody really looking around saying, wow, this is a disaster. There's all sorts of global problems coming because the Fed's got a balance sheet this big. So we learned that the size of the Fed's balance sheet may not be that big of a deal. Certainly the size that we're at hasn't caused any real dramatic problems in financial markets for the macroeconomy. And we can pull all this back. The maturity structure that we have, we did not go out into really long dated securities with anything we've done the last 18 months. So there, we can get our balance sheet to kind of run a large fraction of it off in the next couple of years without any big problem if we want to. So that's a policy choice of how you want to look at the balance sheet. One argument is let it run off so that you have more space later if you need to push it back up. Another argument is it's really not doing any damage, it's not causing a problem. So what's the big deal about shrinking it back down? So I'm kind of more on like, just there's no reason to keep it that big, really. So why not let it just kind of naturally run off as securities mature, let them kind of roll off at a natural pace, let the balance sheet shrink back down to some other smaller size. And that way you have more space if you need to later to push it back up. So I'm not that concerned about it. And I'm all for at some point just letting it just naturally run off until it gets to a size that we're comfortable with.
How does the 2018 automatic pilot experience fit into your analysis?
I'm sorry, say that again, Mark.
How does I think it was 2018 automatic pilot, let the balance sheet roll off experience fit into your analysis? Because there are those who say, that there was excessive tightening in 2018 that the Fed had to reverse in 2019. And that the automatic pilot notion led to excessive tightening in markets.
Yeah, I never quite bought into that story. I mean, again, as it was coming down, we weren't seeing a lot of upward pressure on rates other than what we were doing through actual policy actions. The bigger concern was whether you had enough liquidity in the financial markets to function and have this floor system that we were running. That was really the debate. It wasn't so much monetary tightening, was how much liquidity do you need? How many reserves do you need in the financial system to make sure that the system is flush, liquid, rates are where we want them to be. We just control the Fed funds rate by moving the IOER up and down. That was really the issue. And the thought was we could shrink reserves down to, say, $1 trillion. Well, once we got to about 2.2 trillion, suddenly we had a flurry of financial market disruption in September of I believe it was September of 2019, where the New York Fed had to start stepping in and providing reserves back into the system. So that was really the bigger problem, was like, how big should the supply of reserves be in the financial market? Not so much what they were doing to accommodation at that point. And so I kind of look at it the same way now.
Well, we're running out of time. What's your best gauge of inflation expectations?
Yeah, that's a good question. I mean, you usually have these two measures. You have the survey measures, the University of Michigan, the New York Fed measures, where they just go out and ask households and firms, what do you think inflation is going to be? And you get a distribution of answers. You can also just go to the markets and say, look, if you're buying inflation protected in securities, you're protecting against inflation. What do you think inflation is going to be? You need that to determine what you're going to pay for those securities. So from the markets, you can back out inflation expectations based on what people are willing to pay for inflation protection, because that tells you how much inflation they're thinking about. So I have always tended to favor the market-based ones because people actually are betting money, their own wealth, on this estimate of what inflation is going to be. They're paying for a certain number. And if they're wrong, they're going to lose money. You talk to households, you ask somebody, what do you think inflation is going to be? And they say 10%. So what? Nothing happens to them. There's no cost. There's no benefit. They just are answering a survey questions. They got no skin in the game. So I've always been more leaning towards market measures of inflation expectations because people are actually betting their wealth on this. But the survey measures are what households are thinking and firms are thinking. And if that's how they're going to make decisions in terms of wage demands, borrowing, anything else, you got to pay attention to them. So it's a tricky business to look at these two measures, because right now the market measures are well anchored close to 2%, and the survey measures are off at 4 to 5%. It's this big disparity between the two. So in a way, you have to take both measures and figure out how to use them to determine whether inflation expectations are unanchored or not. And that's a tricky part. I don't want to get in the game of throwing out one set and saying, oh, look, these are great. And then some other time later, I say, oh, these are great. Now that one's bad. I don't like that kind of cherry picking game on data. So I'm looking at both. I'm going to see how everything comes into play when I think about setting policy moving forward.
Well, we have run out of time. That trickiness tells us that you have many challenges ahead to face, as do all of the wonderful answers you provided to a slew of questions from me and the audience today. This is a wonderfully wide-ranging discussion covering the waterfront of topics, shows tremendous breadth, and we are very appreciative that you took time to be with us today. Thank you for a wonderful discussion.
Thank you, Mark. Hopefully someday we can do it again in person.
Look forward to that. Thank you.
Thank you all.
Thank you, audience, as well, for joining us.